Hello. I think y'all can do a better job of giving us a warm welcome than that. I'm sorry, but it's low energy, and we're talking about billions of dollars worth of businesses being made. How do you argue with billions? Billions! Yeah, that's what I'm talking about. Make that money. No, I really appreciate y'all taking the time. Sorry, it's a little goofy. Taking the time to come down here today and talk a little bit about how to create the next big fintech company. I think we're going to expand our discussion beyond just the confines of banking because there's so much going on around fintech broadly that we can talk about. And I'd like us to get into as many of these different areas as possible. We do have an expert on the banking side of the equation with Chris, who has in fact built one of the most successful challenger banks in the US with Chime. And then Angela will talk about everything else. No, I'm kidding. But starting off with you, Chris, is Chime actually a bank?
We are not. We do offer
But it says Chime Banking.
We offer bank accounts. We're the largest and fastest growing company in the challenger banking space. So we don't refer to ourselves as a bank. We do offer a suite of financial products, checking accounts, savings accounts, Visa debit card. We do it in partnership with FDIC insurer banks. And so the bank is the one that actually holds the money. We consider ourselves more of a consumer technology company, a payments company. And so what we've done is we've built the majority of the tech stack from the ground up, which allows us to operate at a very low cost structure. And that allows us to offer a value prop that's very different than most banks in America.
Right.
Which most importantly is, we don't charge you a bunch of fees if you have a low balance or if you go overdraft. So the value prop is around having a modern mobile solution that doesn't rely on fees and just sort of makes things happen faster.
It's amazing because we're just scratching the surface of our conversation, and already there's a ton to unpack. Because I think when you say that you're a payments company, I would think of something like Stripe or Square or any other, or PayPal as payments companies, and not Chime Banking necessarily. Angela, can you talk a little bit about, can you break that down into sort of the different levels that exist and in the payment space? And I feel like we're going to have to be doing this a lot, just sort of like parsing what exactly is happening, because there's so much in fintech.
Well, and if you even look at what Chris has built, like now 5 million users now, like as a user, you see like free checking, amazing, like that doesn't exist. And if you think that as like the tip of the iceberg, there is a lot that goes on underneath, and you can describe this in more detail, but to like partner with banks, and it has admittedly gotten easier, but there's all of these banks that most people haven't heard of. Now, Bancorp is more of a name, but there's Evolve Bank and Trust, and. You don't know who they are. You often don't know like who to talk to. How do you get them to talk to you if you're an unknown startup?
Right.
So this process to do this can take 12 to 18 months to get this deal, and you think, okay, great, I've now got my sponsor bank license, I'm done. But no, you need to find a payment processor partner. You probably need someone to print your cards if you want to do remote check capture, and.
Right.
And so you have to put all of these things together, and you haven't been able to do anything super innovative yet. Then you get to build like your great user top layer. So there's a lot of stuff that needs to go underneath. And then what Chris is referring to is often you can get started more quickly by doing all of these partnerships. But if you really want to provide a better experience, you're going to have to build a bunch of that tech stack yourself.
Yeah, and when I say we're more of a payments company, I'm really talking to the entrepreneurs out here.
Right.
In that the business model is largely around payments.
Right.
We're not a traditional collect a bunch of deposits, make
Right.
NIM, or
you're making money off of the transaction.
make money when the cards get used.
Right.
And we're able to do that in a way that's highly profitable because of our technology approach.
Right. So
And being a technology company, not a bank that's hiring enterprise software companies to run your backend.
Right. Let's talk about that process of reaching out to the bank that wound up being your partner bank, or that undergirds sort of the deposits. How did you make the decision of who to work with, and how did you get them comfortable with working with you as like an early startup with no customers?
Well, that was going to be part of the advice I would give to entrepreneurs.
Well, yeah,
I mean, look, there's all the stories about a guy and a gal, or a couple people get in a garage and figure something out in college, and they work out a multi-billion-dollar company. If you can do that, rock on.
So they drop out of college, right?
Oh,
Right,
yeah,
exactly.
right.
That's the MO.
That wasn't my situation. I actually worked in payments and at other companies. So I worked at Visa for
Right.
a few years.
I've
I
heard of
worked
that.
at Green Dot. I was the head of product at Green Dot and head of corp dev there. So I knew this category really well. And
Yeah.
I would argue that was probably in the early days a superpower that I had in terms of talking to investors, because they said, I'm not really sure this free checking account business is ever going to work, but if
Right.
there's anyone on the planet that I might want to bet on, it's a guy that's worked in that area for
Right.
10 years and has a technology co-founder who's super smart and knows a lot of stuff. So, but getting back to your original question,
Yeah.
it wasn't that hard for me because I know all the players.
Right.
I worked at Visa. They all wanted to be my friend when I
Right.
was there. I worked at Green Dot. We had partnerships with
Right.
many banks, so I knew all the senior executives. So I'm probably not your typical case study in that area. I sort of know everybody.
Well, but so you did have to make a calculation about which of the banks that you were going to work with, and was that really just a matter of who would give you the best rate on the?
No, if you're just going off rate, that is not the right decision. You need to partner with a bank that is, look, these are regulated products, and you have to be, it's a little different than just like renegade software business model where
Right.
you can just iterate and launch stuff without getting approvals, or, we actually have to work within the system. And checking accounts are regulated products. If you're doing a partnership with a bank to help you with a lending product, all of that needs to be worked on in coordination with regulators before you launch products, or else you're
Right.
going to get your wrist slapped.
Right.
So, so there's a lot that sort of goes into
Right.
to that. You can't just do it based on the economics, but the partner that we chose, the first bank that we have a few bank partnerships, but our primary one is with Bancorp Bank today, and or at least it has been historically, and will continue to be.
Yeah, you say it has been, and then that's like the journalist in me just wants to jump on that.
No,
question
I
and
just
be
mean like
what's changed?
we have multiple partners, I guess.
Okay.
But
Yeah.
most people that follow us would know us as being a Bancorp
Yeah.
partner.
Yeah, and I want to.
But it was a combination of they know how to work with entrepreneurs and in partnership with third parties. So they've got processes in place to review how we launch new products and new
Right.
services, and then before we roll those things out, they review it.
So I mean,
with
they
the
really
FDIC.
they have to do it themselves, right?
Yeah, yeah, so
Their
they
own
actually have-
KYC and everything else that needs.
They
to
have
happen.
operations to support partners,
Right.
And so if you go to a bank that's never done that before, just because they give you a good price, that's
Right.
probably
Well, because
risky.
exactly. If you think about it, what's in it for the bank, and there's more and more banks that are becoming these sponsor banks right now, they've realized that they have a asset, which is primarily their license. What are they not good at? Acquiring customers.
Right.
So it's very smart, or building products that are user-facing and great. So it's very smart for them to partner with people like
Right.
Chris to do this.
And-
But then the challenge is, like, they would have people opening accounts, and they're used to putting you through a 20-page KYC application flow.
Right.
Like, that's not going to work for a new company.
Right.
So they have to be open-minded enough to stay compliant, but also work with a startup to be able to provide that better user.
Well, and just even talking about that, I think opens up the window to all of the ancillary services that a company can start around, like how to provide better KYC through machine learning and a better sense of identity management.
Yep.
That's a service that if you wanted to start a business to sell in a fintech, I don't know if there's still an opportunity there or if that's been circumscribed. But you see not only that, but I think that there seem to be two ways, right, that people are thinking about starting fintech companies. One is that you're an overlay on top of a traditional industry's back end and operations, and you're just a better customer acquisition model for them, and you can make money through that partnership. Or you're actually really going after the money, and you're trying to become a lender or get deposits and build all of that stuff out yourself.
Or
Go
I
ahead.
think that there's
You want
a
to say
third, which
Okay.
is the first point. You were hitting on my favorite thesis, which is the infrastructure thesis.
Yeah.
Or how do you sell picks and shovels to
Right.
both the new fintech companies and increasingly the incumbents that have these legacy systems been around for decades. And they don't love them either. They're high cost, you can't update them. And so there are now starting to be large companies that just pick off what can seem like a small piece of back end, but really isn't.
Right.
So you hit on KYC.
Right.
but there's a whole host of other ones. And then there's, like, for instance, there's a company, Synapse FI, and the problem they solve is if you don't have Chris's background, how do you find your sponsor bank? How do you know what a good processor to partner with is? You really don't. You might have a brilliant product idea. And so now you can go to Synapse. They will make sure that you're compliant, you pass all of the bank's rules, but they've already done the bank partnerships. They have all of the different partners that you would need to go with, so you can get started very, very quickly.
It seems to me that, and y'all can correct me if I'm wrong, but it seems to me that in the same way that you've got these different cloud companies that are competing for like infrastructure services in the cloud, you have payment processing companies and other types of financial services companies trying to be their ecosystems themselves. I know that Visa has been making a huge push to sort of recruit startups into the Visa ecosystem. MasterCard, I think the same. Is it better for a startup to work with another startup that's trying to provide these services so that you don't get locked into a particular ecosystem? Or do you want to align yourself with one of these big vendors, like the same way someone would do Azure versus AWS versus Google Cloud or whatever?
Yeah.
There's a lot of different questions in there. It sort of depends on which part
Listen, man,
of the,
unpack all of it.
I'll
Just
try
do it
my
all.
best.
We got time.
There's lots of startups that, or even beyond startups now, that have services for companies like ours. Like we use a company called Socure to help us with our KYC. They're a New York-based company, and you know we knew those guys when they were startups. Now they're, I think, supporting Bank of America and
Right.
tons of really big institutions. And then there's earlier stage companies like there's this company Persona that we're doing a test with right now to help us with additional verification we might want to do with someone, where you can take a photo of an ID and they have the technology to prove that that's a real person or not, and so forth. So yeah, lots of cool companies that that we can partner with.
Does it make more sense to do that than to partner with someone like MasterCard or Visa who can kind of soup to nuts, have the whole thing, like kind of take care of the...
Well, they
that stuff
don't
with you,
do.
or-
They are.
don't do a
They're
lot.
more pix. I mean, everybody knows the Visa and Mastercard brands,
Right.
but it's a switch.
Right.
It just connects merchants and
Yeah.
issuing banks. So, with a great ad budget and a great brand and amazing services. I mean, we happen to partner with Visa
Right.
very closely, so they're awesome partners. But you can't just rely on those guys. I mean, if you want to get in the card business, I would argue you want to do a deal with like a Visa or MasterCard because they have all the acceptance.
Right.
So there aren't that many examples of, just at least in the US, in recent memory, of new networks that are built. The last one is PayPal.
Right.
So we chose to partner with one of the big networks and then just own the consumer relationship. I mean, even though I mentioned the money resides at a third-party bank, we think of it as sort of a tri-party relationship between us, the bank, and the consumer, with us having the sort of primary or lead position in the relationship.
Right. Right. What was the biggest pain point for you when you were starting out? So you had a relationships with all of these guys. You knew, you know the industry, but was there anything that was still sort of a friction for you? What was the toughest thing about getting the business off the ground? Or are you just like, no problems?
No, we founded the company in 2012.
Right.
So we've been at this for a little while. We just had our 7th year anniversary party.
Mazel.
Yeah, it was fun. Thank you. I mean, in the earliest days, it was just proving that this is a business model that actually worked. There had been other examples of companies that had tried to do, and some really cool companies, like Simple was one, that had a great brand, and in many ways, what they stood for is very similar to what we stood for. Just the underlying business model wasn't that great. So I think getting off the ground, the hardest thing, well, of course, financing in the early days. That's when Prosper and Lending Club and every VC we pitched, they'd say, why are you trying to get people to put their direct deposit or their deposit with you? Why don't you give them money? That's a way better business model.
Right.
And those businesses are fine, but you know, here we are in 2019. It seems like every fintech is launching checking accounts.
Right.
So we were a little ahead of the curve on that front.
Right.
But in the early days, it was all about, you know, one of our investors, Satya from Homebrew. He just, you know, his pitch is, you got to make them believe. You got to be able to tell the story of why you're the right team to solve this problem.
Yeah.
And I think even though we certainly didn't figure it out as quickly as we would have liked. I mean, it's been 7 years already. Great progress, but particularly in the last couple years. In the early days, I think there was a willingness to take a bet on us just because of our
you have, well,
category
you
expertise.
you do have a background, like there's something to be said for team, right? Angela, when you look at the business model, though, how did you get comfortable with the idea that challenger banks would be able to generate revenue beyond debit card processing fees and actually, which, as someone noted in the audience, can't cover customer acquisition costs?
Yeah, I think.
Yes, they can.
Oh, they can?
Yes.
Yes. They, we can
Who
get into
said
the,
that?
we can get into the nuances of the Durbin Amendment, which is underpinning half of this industry, but we'll skip that.
I mean, if you want to, we have time.
So so the story, maybe 7 years ago or 5 years ago, was very much around the unbundling of the bank. And you guys have probably all seen this graphic, which is usually picking on Wells Fargo. It's their homepage. There's a dozen different startups at every single line that Wells Fargo does, and a lot of them are lending companies that are breaking those apart. And those companies had a lot of promise and are still doing very well. But I think what we discovered was if you refinance someone's credit card debt, like Lending Club, which is 50% of their business,
Right.
that can be great, but then what next? And so a lot of the lending companies were stuck on this treadmill of having to continuously acquire customers.
Right.
Whereas now, Act 2 of financial services is pick a super strong wedge that's going to enable you to acquire customers, but then think about how do you use that to become more of a platform and bundle on more services. And the reason why checking, you realize this very early, but why getting somebody's deposit is so critical is that, one, it's super high activity. Like, there's not that many financial services products that actually have almost a daily, sometimes, use case. And then two, there's so many more things that you can layer on top of those, and it's so sticky. So it's just like, if you can get people to do it with a great hook, be it get your paycheck early or a variety of different things, there's a lot of other services you can layer on top.
I mean, it sounds kind of gimmicky, but are there still other hooks out there that haven't been explored that you would find compelling to invest in yet another challenger bank?
Oh, there's so many. Like, if you everybody.
What are
in the
your
US,
top 5 hooks?
Everybody in the U.S. needs banking services. And I often speak that there's 2 banking systems in the US. There's one that probably most of us are in. We get credit card offers all the time in the mail. We're totally bombarded. We don't love our bank, but we don't think about it all that much. Then there is solidly 50% of America, or even more, that often live paycheck to paycheck. They don't have a whole lot of savings. They would name their financial institutions as none of the primary banks.
Right.
They need financial services more. They're gouged. They have fewer options.
Right.
There still hasn't been enough new companies and innovation started there. So here's an example of a really interesting hook. 1 in 7 families are on and off what used to be called food stamps. And so you'd think, if you're a large bank, you can't serve this customer because it costs you several $100s just to serve a customer. If you have a way better cost stack, you could. And so this team, who grew up on these social programs, started what was a personal finance manager for food stamps. So you could load in your card that you get from the government. It shows you exactly.
Was that a Y Combinator company?
It was out of another program called Robinhood in the US that goes after this.
Oh, okay. Yeah. I remember.
Yeah.
It's
So,
clever. That
it's
company is
amazing because the
super
user
clever.
experience was you get a bunch of money at the start of the month. You have to call a 1-800 number to get your balance.
Right.
And then nobody is good at budgeting, and so inevitably you run out of food money by week 3, and then what do? This is an app that shows exactly how much food money you have, how you should budget it over the course of the month, and better yet, here are the grocery stores you can go to where you get a discount. That's a pretty amazing wedge, and now they're layering on more banking services.
Right. And I mean, would you be competing for those same customers at some point, or are there different market size? So you're not necessarily going after the unbanked or underbanked. You just want to hit that middle class American.
We target everyday Americans. If they happen to not have a bank account, they're more than welcome to join us. But most of our customers are coming from Wells Fargo and B of A and Chase. They're already banked. They probably got a bank account because their mom opened up one for them when they were a kid, and even high school or early into their 20s. They might have a student checking account that didn't charge fees, but then all of a sudden you start getting charged fees.
But then I would imagine there's a race to add. There's sort of an arms race to add existing ancillary services, right? So what Dave has, free overdrafts, right? Or overdrafts where you pay a nominal $1 tip.
You pay fees for that.
like a tip, you pay $1 instead of 30 or 15 or whatever it would be.
Those sorts of features work really well. I mean, we started with a big value prop that beyond the fees and the Slick app was that we would give consumers their paycheck 2 days early.
Oh, yeah.
They sign up for payroll direct deposit. And a couple weeks ago, we announced the launch of a service called Spot Me, which is an alternative to overdrafts.
Right.
Basically, if you're on direct deposit, then we'll let you take your account negative
Right.
for up to $100.
And then you'll just pull that out.
And then when the next direct deposit comes, we pay ourselves back. And the consumer has the option to leave us an optional tip, which doesn't affect their eligibility for the service.
Right.
So it's completely optional.
And so you still see opportunities around banking then, Angela,
I think there's still, like you look, there are, actually Enrique from Brex was talking about, there's like 42 banks that are over $10 billion in assets right now.
Right.
Right? And think of the number of new neobanks that have cropped up in the US. Like we're nowhere close to that.
Right.
And so how could you segment the population in different ways and provide them different services? Like there's opportunities for large companies there.
When I was growing up, I'll bring it back around. I'm going to say a little anecdote that's going to be sort of sweet and charming, I think. When I was a kid growing up, my dad would read me this book about the Bernstein Bears, and they always had you lessons about what you shouldn't do. So if you're starting if someone is pitching you on a banking startup, what should they not do? What are the things they shouldn't do?
The expression I like to use a lot, which answers your question, is the battle between incumbents and startups comes down to whether the incumbent can get innovation before the startup can get distribution. And I think the mistake that often very smart product-minded founders make, and it's a real advantage, especially in this space, to be a product-minded founder, is that almost more important than that, you need a smart distribution strategy. And so what is your hook that is either going to be compelling enough to get people to switch from Wells Fargo or B of A, or to acquire customers that aren't even thinking or totally don't trust the banking system? And so really coming from this, how do I acquire customers first angle, and then layering on other types of products.
And you said that your customer acquisition costs are covered by the interchange, by the rev share you're getting off of the transactions.
It depends how you are able to engage the consumer.
Right.
So in our case, we've got a lot of features that we very deliberately structured in a way where the feature would essentially unlock if you signed up for direct deposit.
Right.
And then if you sign up for direct deposit, you tend to capture a good amount of spend naturally.
Right.
It's also like what target segment you're going after.
Right.
Like if you're a Chase Sapphire Reserve customer or you're an Amex Platinum card
Right.
Person, we're not.
Yes. Go on.
Well, if my acquisition team is spending dollars to try to convert that person, they're not doing a good job, right? Because I'm not trying to change them. I'm trying to capture consumers who prefer to pay with debit cards, and that's really been a secular trend that's happened over the last 15 years. If you look at Visa and MasterCard, there's more debit card transactions on a monthly basis than there are credit card transactions. And if you look at just demographically, younger consumers overwhelmingly prefer to pay with debit cards.
Right.
And the reason for that is control.
Right.
And particularly for people that live paycheck to paycheck, so not the unbanked, just a normal person, they'll sacrifice the rewards that they'd get on a Cap One card in order to just have a better control of paying with a debit card. In our case, there's even more control because you're not going to get an overdraft fee, or we're not going to sneak something on you. Our members know that we have their back.
Right. Now, this is not me asking this question. This is the audience asking the question, so don't get angry at me. Is Chime profitable?
We could be profitable today, but we're spending money on acquisition dollars.
What's your funding plan?
We just raised, we announced a $200 million Series D.
So, not for a while.
We're good, I think.
We're good.
Yeah, that was announced.
It depends how many customers you want to acquire.
Yeah, that was announced in March.
If SoftBank wanted to throw another like $500 million at you, would you take it?
We talked to a lot of guys.
All right, now I'm getting into journalism-y questions instead of how-to questions. I was told not to do that by the bosses, the folks upstairs. So I think like getting back to the notion of what might be most profitable for this audience to think about, where are the opportunities outside of banking right now? Like you mentioned picks and shovels, but is that sort of broadly applicable in the financial services sector? Are there particular areas of financial services, whether it's like mortgages or insurance or I don't know, pick a thing that's a $10 billion business that still sucks?
Yeah.
from a technology
Yeah,
perspective.
we, the term FIRE, financial services, insurance, and real estate, which depending on your geography is up to 20% of GDP. So very, very large industries. If we stick to banking or financial services writ large, we could talk a lot about insurance and real estate.
Right.
So we talked about basic checking, which is still a very large opportunity. But if you look at most of the profile of Americans, and just go by category, there's $1 trillion plus of credit card debt, way more, like 1.5 in student debt, and so I think there's a story around, how can you keep people in good financial health, but the reality is a lot of people are in terrible financial health.
Right.
And how do you help them get out of that?
Right.
There's a lot of companies years ago that were very well-intentioned trying to do more financial education, which is important. Like, we would all be better off if we really understood the intricacies of the financial services world. But it's really complex, and most of us have better things to do with our lives than study this in depth. And so what we're seeing now is this trend of how can we abstract away the complexity and almost automate those decisions, or at a minimum, automate and surface to the level, you need to pick A or B, and here are the very easy to understand in layman's terms consequences. So concrete example, Tally, which helps you get out of credit card debt. Most people who have credit card debt across 4 different cards. That's 4 different due dates. Nobody puts it on auto pay because they don't want to get spun into overdraft. So just think of the process management of this. And do you pay card A first or B first? How do you get out of it? So it just grows. It's a super tough problem. Tally can link your bank account, your cards, take over that process and just say, hey, why don't you make this payment this month? And by the way, if you keep this trend up, you're going to be out of debt in 5 years versus indefinitely. I think there's a lot more opportunities to do that in student, et cetera, et cetera.
Can you actually sort of just give me 5 discrete opportunity sets that you see? So like if Tally is one around sort of helping people manage their debt and getting out of debt, and debt is one. Just, it doesn't have to be 5, but 2 or 3 more.
Yeah, I still think there's a lot in credit card debt. I think student debt, we're just starting to tip the iceberg on that. And the challenge there has been most of student debt, as you know, is held by all of these student debt servicers. And that's where a lot of the information lies. So I think there's also an opportunity in the infrastructure layer. So if Plaid has connected all the different banks and allows you to extract data from that, they're also trying to do that in the student debt market. And I think that will spur a bunch of companies on top of that.
That's very interesting. If you were going to make a fintech company today, what would you build?
Well, I would naturally do another fintech company because that's what I'm good at. But
Right.
I don't know. It'd be kind of cool to run like a pizza shop or something.
Really?
Yeah.
I mean, you don't want to Max Levchin it up and go from PayPal to a firm or whatever and do a couple.
Well, I'd invest in one. I wouldn't
Well,
actually.
Max had a games company in between, and so maybe the pizza shop is.
Is it going to be a robotic? All right, I'm sorry, I'm digressing.
Oh, yeah, like a Zoom. Create a Zoom.
Yeah.
That'd
When you were starting your company, does geography matter at all? Should people think about what region they're going to launch in first, because the regulatory environment can still be a little thorny in different states for different kinds of companies. So is there one sort of locale or geography that's most open to this stuff? Is it still Delaware?
We didn't start locally, so our bank is regulated by the FDIC, so we were able to operate in all states.
Right.
And we very
Well, you were able to do that because you had a bank that was behind you as a partner.
Right.
But let's say,
but our consumer marketing plan was very much just national audience.
Right.
And
Is there any category for which it matters, a geography?
Yeah, I think you could decide. So let's say you have a new creative lending idea, and you want to test it in the market before you go to the trouble to build a super robust infrastructure. Like, I made this mistake at my startup 10 years ago. Like, we were ready for millions of users and built this amazing infrastructure, and really we should have built a shitty one and just focused on how do we get customers. So I think that is good advice that still applies today. So you want to test it out. Maybe you want to get one state lending license before you do a big type partnership. And then you have this trade-off between, speed, how quickly can you get the license, probably rate, if you want to charge higher or lower rates, that's very state dependent. And then just sheer size of the state. Like, it's better to get a lending license in Texas than it is in Arkansas.
Right.
So states
Although
vary
it might
that
be
way.
easier to get a lending license in Arkansas, and then you can sort of.
So if you want speed, Utah wins. just not as large. And then Texas can still be pretty friendly. New York's regulators are pretty tough, so you might want to put that last. But those are some of the things you would consider if you want to just test the market before you build a robust infrastructure.
Are there other sort of hacks that can help you get to market faster? Like acquiring, say, a business that's already been operating for a certain amount of time, like 10 years or something, and then just like taking them over so that you don't have to deal with certain permitting or regulatory sign-offs. Someone in the financial services sector was telling me something like that. There's a way to make your business older faster so that you can get through approvals a lot quicker.
In some industries, I've spent a lot of time in mortgage.
Right.
And why does it take 45 days in this day and age to get a mortgage?
Right.
It turns out there's a lot of reasons for that. It actually is very difficult. And then once you get it, the whole payment experience is crap also. And so when you get into that space, you can sometimes accelerate your time if you buy a company already in the space. And that does two things, even beyond the licensing. It turns out to get mortgage right, it's not really a couple of things. It's like 400 different processes that you need to understand at a very deep level. And so you're almost buying some of that institutional knowledge while you bring in your fresh thinking. So sometimes that can help accelerate. Interesting.
I had a question and then I lost the question, so I don't know where it went. It's somewhere in the ether. It's up there floating around. If you were to, can we talk about insurance for a little bit, or do you consider that like a different?
No. Insurance is great.
I feel like this is all of the same
piece.
Insurance
is the next big wave, and there's probably some insurtech entrepreneurs.
See, there you go.
In the audience here.
Oh, I remember what my question was, actually. It was about mortgages. Doesn't the blockchain solve all of this? No, I'm sorry. I'm kidding. I swore I wouldn't do it. But I had to bring up blockchain at least once in a fintech panel. Otherwise, it's not a fintech panel. But seriously, and within insurance, is it just across the board right now? Like the whole category is just so broken that you can kind of pick whatever spot you want in it?
Oh, there are so many opportunities. So this is a $5 trillion industry worldwide, where 1 in 10 Fortune 500 companies is an insurance company, and every single one of them was started before World War II. So this speaks to the opportunity, but it also speaks to how damn hard it is to build an insurance company.
Right.
There's just a lot involved. And so some of the opportunities, and there's a similar almost sponsor banky model that goes on in insurance where you can become an MGA by partnering with an existing carrier.
Right.
And that can be a great way to start. And then the two ways that companies are prosecuting this opportunity, and the ones that I like, are either coming up with a new and better underwriting model.
Right.
So, pre-World War II, you didn't have nearly the amount of data that we have on all of you right now. So you can imagine, how are you scoring risk? Not in a very sophisticated kind of way. If you were going to revamp that based on all the tools, it would be completely different. We have a company called Health IQ, which does life insurance for health-conscious people. So if I knew that all of you ran 50 miles a week, I would give you way better pricing than the standard data that your life insurance company is collecting. And then by having this better underwriting model, what it also enables, back to my customer acquisition drumbeat, is positive selection bias. You're bringing in the best customers, and then you're able to attract them at a cheaper rate because you can just be much more targeted. They target runners, they target vegans, like all of these people that would be better risks for the insurer. And there's lots of opportunity there across every single different category.
That is so cool. There's a question that came from the audience, which is about the geographic scope of Andreessen's investments itself. So would you look, and I know the answer to this already, but for them, would you look outside of the US to places like Latin America to invest in financial services opportunities there?
Yeah. Arguably, the opportunities for financial services outside the US can be even bigger.
Yeah.
And this is a combination of even a larger underbanked population, and then just fewer companies that are prosecuting those opportunities.
Haven't you deployed capital already?
We have a few companies down in Latin America. And the chart that I often show when I'm just giving a 101 in this space is, if you look at credit card penetration, let's take Colombia, for instance, because I have an investment there. It's like 10%, 11%, 12%, which is reasonably high, actually, for many countries. Smartphone penetration, 80%. How are you going to deliver banking services? It's pretty clear.
Yeah.
So the opportunity is really large. The challenge is that, unlike in the US, where although often the infrastructure is bad, you can partner with someone, you can get up and running pretty quickly. The infrastructure in many other companies doesn't exist.
Right.
And so you have to build a lot of that yourself.
Right.
And so I think there are two opportunities. There's a direct-to-consumer opportunity, but we're also starting to see more infrastructure companies that are coming into different countries.
Getting back to banking for a second, another question from the audience. Banking charter versus banking license, which one do you want? Is there a difference? If there is, I don't know.
No, I mean, it's something to pursue. We could pursue a bank charter.
Right.
And some fintechs have decided to chart that path.
Right.
We've decided to go down the partner path
Right.
for now.
Is there a difference between getting a banking charter versus a banking license? This is something I don't.
I think in Europe it's called a banking license is generally what
it's
it's.
the same- so it's
in
the same thing.
US, it's generally a bank charter. But
Okay.
I think it's generally the same thing, just different.
Right.
regions.
Yep.
And as an investor, you don't favor one or the other. If someone wanted to get a charter and be like a fully licensed bank, that is an opportunity that's an investable thesis, right?
That is part of an investable thesis.
Okay.
Because I think you can, and there were a bunch of startups that were trying to do this, which were, back to your purchase question,
Right.
I'm going to go buy charter over there.
Right.
And then we say, great, what are you going to do with it? Right? And so
Right.
I would reverse that and say what you want to do is figure out why customers want to use you.
Right.
Get them using you, get them really sticky, and then are there things that you either can't do or do you want to improve your economics? Then go get a banking charter.
I agree with that. There's companies in our space who are just like dead set. We are going to get a bank charter. We're getting a bank charter.
Tons
It's
of
like, but to solve what problem?
Right.
Who is the segment you're serving with what features and
Right.
products? So
Well, I mean,
I agree wholeheartedly that you start with that. And then if you need a bank charter in order to offer the products and services you want for that segment,
Right.
then you should go and do it. If you can do it in partnership, that might be faster and easier too.
I mean, for your customers, do they get? Right now, interest rates are basically zero, so it's kind of a moot question. It doesn't really matter. But like, let's say interest rates actually improve to the point where you can have a savings account and it generates interest and it's a meaningful amount of money. Will you be able to offer that kind of service at some point, or for that you would need a banking charter, or can you?
No, you can do that through partnerships.
You would do that
too.
through the partnership.
Yeah, I mean that's sort of a dime a dozen these days.
Right, okay.
Seems like every startup's got high interest savings.
Okay, good to know. I should not be working with HSBC right
Yeah,
now.
you could be getting 2% right now versus 0.6
HSBC is the
whatever.
worst. HSBC is the worst, and they're not actually the worst.
Have you heard
They're
of
fine.
Chime?
New customer right now, but what about my black Amex card? That's really the question.
We have metal cards,
Mm.
and we don't charge monthly fees for them.
I'm sold. I'll sign up today.
Just refer a few friends, and we'll send you one.
Really, I have to refer people. I'm so lazy, and I don't have friends. These are two problems.
I count several. Many.
Well, they're here for you, not me. How do you
I
attract?
did get that question once, literally.
Really?
Yeah, well, because you want to do stuff that's fair. It's like, well, what if someone doesn't have friends? I'm like, I don't know. Give them some free stuff. I don't know.
How do you attract traditionally unbanked populations to digital banking financial services? Like, what do you do? Is it the perks, like the?
It's hard, and I've seen a lot of companies try this over the years. And the challenge is, one, you've got a huge mistrust.
Yeah.
And then two, you have to make the economics work for a customer who could be a really good customer, but they're not going to spend several $1,000s a month. And so the place to do it is to find a wedge either of a product that they're already using that's terrible. So take my food stamps example. Like, that's a great problem. Like, he observed people in the grocery store with a cart full of groceries calling the 1-800 number on the back of the card, and then looking down at the grocery basket being like, oh shit, do I not buy like bananas for my family today?
Right.
Like, that's a horrifying experience.
Yeah.
Great place to get customers with a better product.
Right.
So what are some of those just more emotional touch points in someone's lives when you can come in versus, hey, we're another lower fee card that everybody's advertising, and we might be better, but I don't know how to trust you because I'm bombarded with all sorts of payday loan offers and a variety of things that
Right.
have fine print that I don't trust.
Is there a point at which startups should start talking to regulators, or do they not need to worry about the regulatory environment? You're both just nodding. It's like, I don't know if
we
that was a
definitely-
profound question or not.
We talk to regulators all the time. I mean,
So at what point do those communications need to start? If you're building a fintech company, do you go to everyone the day you decide, I'm going to be a fintech company and start having those
I mean,
discussions?
it depends
or-
what angle you're taking. Like I said, in our category, it's a regulated product, so our
Right.
partner banks started by talking with the regulators, but over time, as we've scaled,
Right.
we've had conversations. We regularly speak with the CFPB. We've met with the chairwoman of the FDIC. We definitely have a lot of interaction. They're certainly aware of some of the noise we're making in this category. But if you're creating a product that actually has the best interests of consumers in mind,
Yeah.
that doesn't rely on fee income, like they love us. We're a case study on ways to do financial services and banking in a way that actually helps consumers.
Would it be a threat to your industry if a Democrat was elected president?
It wouldn't
Like,
be
do
for
you
us.
think the economics would be worse in what I would assume would be a tighter regulatory environment?
I think in
Sorry, that was a reporter question. We don't
no,
need
but
to.
it's like both. Every
there was something-
regulator and politician should want to bring up and provide fair access to financial services for everyone.
Yeah,
So
sure.
there is a storyline that is very cross-party in this industry.
You know what? I think I've done the impossible. We've gone over 40 minutes in a discussion about financial services in the afternoon. I appreciate all of y'all for coming out and paying attention. Thank you so much. This was really fun. It was really great
Thank
to
you.
talk.
Thanks a lot.
Thank you.